Most of a probability distribution is between the average minus 2 standard deviations and the average plus 2 standard deviations. We actually had a downward movement of 2.5 standard deviation. Well, that's okay, that can happen.
Yeah.
There's 2.5% chance, with a bell-shaped curve, there's 2.5% chance that you'll get worse than a 2 standard deviation downward movement. So that's 1 in 40 years. So
Yep.
we had a 1 in 40 years happening. You've just got to be able to withstand that. You
That's
have to
right.
have a combination of stocks and bonds, a combination of risk and return, which allows you to say, well, that's what 2 standard deviation move. They told me that would happen.
Right, right. I don't know if you've seen, but a handful of journalists have been questioning the Harry Markowitz model. I don't know if we've just read about it recently. And they
In the New York Times?
I think it was in the Times, yes. I don't have the article in front of me, but they claimed that modern portfolio theory was no longer relevant thanks to the globalization of capital markets. Or in particular, they said during this year there was basically nowhere to hide and everything went down together. What's your response to that?
Okay. I'm glad you asked that question.
Okay.
Okay. Now, when you're trying to anticipate the future, the future is uncertain.
Yes.
Market may go up, the market may go down.
Right.
Now, some asset classes, we'll talk in terms of asset classes, are more volatile than other asset classes.
Right.
Let's suppose we'll take as our benchmark, as our standard, the S&P 500, Standard & Poor's 500.
Right.
And so we'll say that has a beta of 1. When the S&P 500 goes down 10%, the S&P 500 goes down 10%.
Yes.
But emerging markets are more volatile. I don't have their beta in front of me, but let's suppose that when the S&P goes down 10%, the emerging markets, in fact, go down 20%. Then we say they have a beta of 2.
Right.
And in fact, the emerging markets in the 2008 year went down a lot more than the S&P 500.
I think we saw it hit 60% negative.
Right.
Yes.
Right. So instead of 38.5% decline, it went 60%
Yes.
down. And so that's what you're supposed to expect.
Right.
So that part of your planning in advance is you should have a combination of asset classes that are efficient in the sense they give you minimum risk for a given expected return.
Right.
It doesn't, some people, some financial engineers talk about risk control. Us portfolio theorists do not talk about risk control. It sounds like you could control risk.
Right.
You can't. You can say this part of the efficient frontier, the risk-return trade-off curve, has high return, but it has high risk. This one has lower return, has lower risk. What makes up part of the riskiness of this one is it has more asset classes like emerging markets that do well on the average over the long run, or at least have,
Right.
historically. But they are riskier. They have higher beta,
Yes.
and others have lower. So portfolio theory was not invalidated. It was validated.
I think so, yes.
Suppose that you had, on your own, decided you're going to be 60% in stocks, 40% in bonds. The stocks were S&P 500. The bonds were,
Right.
high-grade bonds.
Sure.
Okay. And you had 600,000 in the stocks and 400,000 in the bonds.
Yep.
Now you watch the 600,000 fall to 400,000,
yeah.
400,000.
Yeah.
Whereas the bonds, they went up. But I
That's
suppose they say the same.
Yep.
Okay, so instead of having 1 million, you have 800,000. Now that, you're not happy, but you're here to invest again.
That's
Whereas
right.
if you had put all your money.
Yes. Well, Harry, it's a pleasure.
My pleasure.
It's
My
great
pleasure.
having you here today and being able to spend so much time with you. And it was great that you spent a little time with our web viewers as well.
Thank you.
Thank you.